In the last lecture, we took a look at the income statement. We saw how it could be a useful tool to gauge the profitability of an organization. We saw how it could be a useful tool to evaluate management's performance using assets to generate profitability. But we also saw that it wasn't so straightforward. One thing came up was the question of timing, cash basis versus accrual basis. We're going to look also into flexibilities that management can take advantage of in order to impact the income statement beyond just their performance. So looking at the income statement that we left you with in the last lecture, we had a simplified version, but then we also learned that there's a difference between what they call transitory and sustainable revenue and expenses, right? Sustainable revenue is ordinary, normal, we can expect it to be here in the future. And then we have transitory items, which are infrequent or they don't occur very much. And so because they are not expected to reoccur or not occur very often, we don't want to use them to make predictions because they're probably not going to happen again. So in this version of the income statement, we break that out. We see the unusual and infrequently occurring items, right, broken out so we can see some of the transitory items. And we also see something called a discontinued operation. So discontinued operations are elements of the business that we're no longer going to have. We're kind of phasing out. So for example, if Southwest Airlines was shipping cargo and they decided to stop that, then they would phase that out. That would be an example of a discontinued operation. Since that's not going to happen in the future, then we want to separate it out so that the user can see what's transitory versus what's sustainable. So kind of walking down this income statement, we see the revenue, which is what's coming in, minus the cost of goods sold, and that gives us the profit. So this will give us our gross margin to see what kind of markup we have if we're selling goods. Then we subtract from that our selling and administrative expenses. These are normal day-to-day items such as your payroll, your accounts payable, your accounts receivable, your accounting department, your customer service, your marketing department. Then we have here the unusual and frequently occurring items that we kind of covered in the last time. These are our transitory items. This gives us income from continuing operations. Now this is before we've calculated taxes because we have to get this number and then apply the percentage, let's say 20%, which is a common tax rate for corporations. We apply that and we get the income tax expense. Then we subtract the income tax expense from the income from continuing operations before income tax, and we get the income from continuing operations. Then we subtract from it the discontinued operations, in this case a loss, but if we had a gain, we would put the gain here. But because this is a transitory item where we are separating it out so that it's not commingled with the things that are expected to continue, the operations that are not discontinued, and then we get our final number here, the net income, that we're able to use as the final, as they say, bottom line. Now all along the way, as managers are reporting the revenue and expenses, there are areas in which they have some flexibility. The rules for GAAP provide some flexibility, and that's a necessity, right? Think about all the different types of businesses and operations that are out there. The types of businesses are, potentially infinite in what people can decide to do, and so you can't have a specific rule for every specific situation. Instead, you have to have more generalized rules that you can apply to any situation, and that's the problem with GAAP when the managers are able to exploit that flexibility to make the financial statements look like they want them to, as opposed to how they should. Now, remember, the financial statements are audited, and because they are audited, managers have to be crafty about this. Now, I'm not saying this to put down management and say management is all evil or anything like that. I'm just talking about it in a way to help you understand that this exists so that we are aware of it when we're using the financial statements. Okay, so again, earnings management is exploiting the flexibility of GAAP to mask underlying performance of the organization. So let's look at some of the more common earning management devices that management might use. One earning management technique is called intentional bias in estimates. You have to make estimates in all kinds of things in determining the financial statements. You might estimate, how long you're going to use a building. You have to estimate maybe how much that building is going to be worth at the end of its useful life. You have to estimate things like what we think is going to be our bad debt. What do we think we're not going to collect from our customers? So let's look at depreciation. As you recall, depreciation is spreading out the cost of an asset. For example, let's say we bought some equipment for our factory for $100,000 and we're going to use it over, let's say, 20 years. That 20 years is an estimate. If we bought it in 2020, we're not going to expense $100,000 in 2020. Instead, we want to expense only what we're going to use. So we would only use 1/20th of it. So that would be $5,000 expense if that were the case. However, management might say, well, we want a little bit more profit this year. So, and when we calculate the depreciation on this new equipment, let's calculate it as 25 years. I mean, who's going to really know that we're going to use it in 20 or 25 years? Instead of 5,000, now it becomes 4,000. And so we have more profit because our expenses are a little bit lower. Again, because there's no really way of us knowing if we're going to use the asset for 20 or 25 years, it's very hard for the auditor to be able to pick up on that. So that's just one example of exploiting an estimate in order to get the financial statements to look a certain way. Small example, but it's one of the ones that we have to consider. Another device or another tool that management might use is called the big bath. So think of it like this. If something is bad is going to happen for the company, and the investors, the creditors, the analysts, they all expect something bad to happen, why not throw a few more things into the bath along with it so that when things start to turn around, things really turn around? For example, let's say a company has to go through restructuring. That means they have to close some plants, right? They have to do some layoffs. They have to consolidate operations. So management might say, well, investors are already expecting the bad news, so why don't we throw in something else? Like, why don't we write off some excess inventory this year too? That way, when things turn around next year, we don't have that excess inventory weighing us down next year, and it's not going to hurt us as bad this year because we are already expected to have a hard year because of restructuring. So that's what the big bath idea is, the big bath tool that management uses. Another tool we have is called the cookie jar reserves. So in this situation, a business is going to oftentimes need to put money away for future obligations. For example, a car manufacturer might put money away for future warranty obligations, or perhaps a retailer for sales returns. So they have to put money away, for these things that are naturally occurring. So what management might do is kind of help them out when they have bad times by putting in a little extra reserve in good times. A little extra reserve in good times, less reserves in bad times, and then that way they smooth out those earnings. They call that the cookie jar reserves. This final earning management tool we're going to look at is called an intentional error. So management makes intentional errors that aren't so big because oftentimes they are overlooked. So oftentimes they're small enough to be considered immaterial, meaning that they're not significant. However, if management does this enough, it can add up to be significant, to be material. So for example, let's say that they accidentally hold off on expensing an item until next year, even though it would properly be expensed this year. That way it helps them in the current year. It doesn't seem like a big deal, but that again could add up, and when we add up all these errors, it could be significant. So I said that was the last earning management technique, but there's one more I want to talk about. It's called premature or aggressive revenue recognition. So with this, the management aggressively books revenue on the income statement. A great example of this is on the income statement of Enron. They used a technique called mark to market. And so when they built a energy producing plant, even though they hadn't sold any energy, they immediately booked all the future sales of energy that they expected to get from that plant that they built. Now, they did get this approved by the SEC, so at the time, even though we later looked down on this, at the time it was accepted. However, this aggressive revenue recognition does cause problems, and it might look good on the income statement now, but in the future you have to find revenue somewhere else. So this year's revenue might look great, but next year's revenue is going to struggle because you've already booked the revenue for it. And so that leads to managers making more and more aggressive decisions to get revenue from other places.